Just a few weeks back, the Reserve Bank of India launched their Retail Direct scheme. Under the workings of this scheme, retail investors like you and me can now transact in government securities directly without having to go through a broker or a mutual fund. In this video, we shall examine the scheme in greater details as we look to answer some of the most commonly asked questions on this topic. But before we begin, ek avashyak सूचना. We've been receiving requests for some time now to create video content in Hindi. It's something that we always wanted to do, but having the same channel serving English and Hindi content was not fitting in well, which is why we have now launched a new and exclusive Hindi-only YouTube channel, which I sincerely hope you will subscribe to और आप अपने दोस्तों को भी बताएंगे. With that being said, let's begin. Government securities, or GSEC as they are often called, are financial instruments through which the government borrows money. In other words, when you invest in a GSEC, you're basically lending to the government against which you receive an interest on the bond and a promise that the government will pay back the principal when the bond matures. Now, the RBI Retail Direct platform allows us to invest in four kinds of GSEC. The first kind are treasury bills or T-bills that the Government of India uses to borrow for a short period of time, typically between 91 and 364 days. The second type of product offered under the platform are the Government of India dated securities, which are nothing but long-term government bonds wherein the borrowing ranges from 1 year to 40 years. The third instrument on offer are state development loans or SDLs, and as the name suggests, these are issued by a state government with a typical borrowing period of 10 years. And finally, we have the sovereign gold bonds, which are RBI issued government securities that are denominated in grams of gold. So T-bills, Government of India bonds, SDLs, and the sovereign gold bonds are the four kinds of government securities that one can invest in through the Retail Direct platform. Government securities offer a range of benefits to investors, and in this section of the video, we'll go through some of the key ones. Benefit 1 is that these GSEC carry very minimal credit risk, which means that the only way you don't get your principal back is if the Government of India defaults, which is something that has never happened in history. A second benefit of GSEC is that they offer decent yields over a longer duration and can be an attractive option for retirees and savers who prefer a low-risk, moderate return investment product. The third benefit is that government securities are tradable in the secondary market and investors can make capital gains on them by accurately predicting the interest rate cycle. Benefit 4 is that GSECs generally have reasonable liquidity, and it's a topic we'll discuss in more details later in the video. And the final benefit of buying government securities is that it helps with an investor's asset allocation and portfolio diversification efforts. RDG stands for Retail Direct GILT and is an account that a retail investor needs to open with the Reserve Bank of India to trade in government securities. This account can be opened and operated completely free of charge, which is the first benefit of using a Retail Direct GILT account, as it helps save commissions and expense ratio that a broker or a mutual fund would normally charge. The second benefit of using an RDG account is that it allows investment in T-bills, government bonds, and SDLs for as low as 10,000 rupees, which then supports liquidity, affordability, and wide-scale adoption of this facility. In fact, retail investors looking to park money for short periods like 3 months or 6 months can do so using a T-bill. This way, you're not only investing in one of the safest instruments in India, but you also get a predetermined yield, which means you get a fairly good idea of how much returns you're going to make if the T-bill is held until the maturity. A third benefit of your RDG account is that it allows the buying of sovereign gold bonds at any time. Now, this is something that you can also do with a demat account, but one has to pay a fee for opening an account and for maintaining it, which is not the case with the RDG account. Earlier in the video, we said that a GSEC has little or no credit risk. This is definitely true for a country like India, which amongst other things has a history of zero default, whose stock of foreign currency denominated sovereign debt is very low, and even our short-term debt is worth less than 20% of our foreign exchange reserves. But while a GSEC is safe from a default perspective, it's important to note that the price of these securities do keep on fluctuating in the secondary market. As a matter of fact, prices of Indian GSEC can get affected by the mere speculation in the direction of interest rate changes, inflation, market liquidity, RBI announcements, etc. Which means if you are investing in these instruments with the purpose of making a profit via capital gains, then while a GSEC is safe from a credit risk perspective, its price can have up and down movements depending on some external factors that we mentioned earlier. On the other hand, if you're looking to hold these government securities until maturity, then your safety level is on a much higher pedestal. A retail direct GILT account is an account one needs to open with the RBI to access and trade in government securities in retail lot sizes. More specifically, the account allows individuals to buy government securities directly in the primary market through auctions. It allows for the buying and selling of government securities in the secondary market, and it also helps with account maintenance services like accessing the account statement, nomination facilities, pledges, grievances, managing one's profile, etc. Now, a retail direct GILT account or RDG account can be opened by residents and non-resident retail investors, and the requirements here are rather simple. The individual should have a rupee savings bank account that is maintained in India, a permanent account number or PAN that is issued by the Income Tax Department, a valid KYC document, scanned copy of your signature, valid email ID, and an Aadhaar number that is linked to a mobile number. An RDG account can be opened on an individual basis or even on a joint basis, but do note that an individual can be the primary account holder in only one RDG account. There are essentially 5 steps in opening an RDG account. Step 1 begins with the applicant logging onto the website rbiretaildirect.org.in and initiating the registration process. Step 2 is where one needs to furnish basic details like the applicant's full name, PAN, mobile number, email address, date of birth, and the username. At this stage, the applicant's mobile number and email ID is authenticated using an OTP process, and once that's done, you shall be given a reference number that will help you track your application. Step 3 is the Know Your Customer or KYC verification process, which can be done using the KYC or Central KYC option, or option 2, where this can also be done as a video KYC. Step 4 is where the applicant completes the nomination details, which is compulsory when opening an RDG account. The application allows for up to 2 nominees, and in case you want to change it later, this can be easily done via the Retail Direct portal. And finally, there is step 5, which involves the linking of the applicant's saving bank account with the Retail Direct account. This process is done by crediting a token amount into the applicant's bank account and verifying the same. This step is rather important because your rupee saving bank account is where all the funds arising out of the purchase or sale of GSEC will be settled, in addition to all periodic coupon payments and redemption amount. And that's it. If steps 1 to 5 are done and the KYC is successful, a retail direct GILT account is opened and details regarding the account number, login ID, and password are emailed to the investor. There are 2 ways to buy government securities through the Retail Direct platform. The first approach is to place a bid in the primary auctions. Now, primary auctions are held on different days of the week for instruments like dated GSEC, T-bills, and STLs. This process happens through the platform, and individuals need to fund their bid before the closure of the bidding or subscription window to avoid cancellations. The second method of buying government securities is by placing a buy quote in the secondary market portal, which works a lot like buying shares through your online trading account. The selling of government securities is pretty straightforward. Investors who hold these securities in their account can place a sell order in the secondary market portal. And if someone purchases it, then the value is reduced from the seller's account and the realized money is then credited to the seller's registered bank account. The first concern is that it might not be easy to exit your investments. And no, I'm not talking about a selling window, a lock-in period or something like that, but I'm specifically referring to the undiscovered liquidity in these RDG accounts. You see, the platform itself is very new, and until awareness improves, there might not be enough buyers and sellers at certain point in time. This not only disturbs an investor's exit strategy, but can also lead to mispricing, which is typically seen when sellers have to exit at a discount or loss due to the non-availability of buyers. So for RDG accounts to be successful in the future, liquidity is a key aspect, and the RBI will need to ensure there is enough of that. A second demerit with regards to this platform, or more so with the instrument itself, is the lack of tax incentives on returns. Let me explain this. When one buys a government bond, the investor is paid an annual or semi-annual interest on the same. Now, this interest is fully taxable at the investor's income tax slab. So, for example, if a government bond fetches a 7% annual interest and the investor falls in the 30% income tax slab, then the post-tax return for that investor will be about 4.7%. That's something that all investors should be wary of and should look to always measure their returns on a post-tax basis only. In this video, we've looked at both sides of the coin. We examined the benefits of investing in government securities, and we also looked at the concerns and limitations that the retail direct scheme presents. In our opinion, it comes down to a few decisions that an investor needs to make. Number one, look out for post-tax returns. Interest rates in small saving instruments like PPF, National Savings Certificate, etc. are set by the government. These rates are expected to follow a formula set by the Gopinath Committee and are in larger parts linked to the GSEC yields. Now, as it stands, the currently prevailing rates on these schemes are about 0.5% to 1.5% higher than the formula-based rates. Now, this might have some political overtones to it, but from our context, it means that these schemes are more attractive from a returns perspective. Additionally, many of the small savings schemes are tax exempts, but on the flip side, there is only a limited amount of money that can be invested in them, and they often come with a big lock-in period. But if liquidity is not a pressing issue, then one can certainly look to max out their investments in these schemes before considering the purchase of government securities. When it comes to debt funds, a lot of what happens in this category is capital gains. And if the holding period is less than 3 years, then debt fund capital gains are taxed per the investor's income tax slab, just like how taxation works with interest on government securities. However, if the holding period is beyond 3 years, then debt fund taxation starts looking a lot more efficient with indexation benefits kicking in. Net-net, returns are important, taxes are important, and looking at returns and taxes in unison is even more important. The second decision area is the liquidity factor, and as discussed earlier, that until the RBI initiative becomes more mainstream, there is likely to be some niggles in the exit process. So as an investor, if urgent access to your money is an important factor, then you might want to look at a debt fund which is a lot more liquid and access to your funds is just a redemption request away. Of course, if you are prepared to hold on to the security for a longer duration and are not likely to have an emergency type scenario, then government securities should certainly be looked at. For instance, retirees might look at GSEC as they are super safe. You can buy as much as you want. The yields are known if the instrument is held until maturity, and more importantly for them, a GSEC pays a half yearly or annual return, which is generally the kind of product that they tend to prefer. A third consideration one needs to keep an eye on are the interest rate cycles. You see, the retail direct scheme comes at a time when the interest rates have bottomed out and are expected to go up. And since bond prices and yields are inversely related, a rising interest rate scenario might require investors to incur mark-to-market losses if they sell their GSECs before the scheduled maturity. Now, the reason why this point is in our decision set is because interest rate cycles are multi-year movements. I mean, it is entirely possible that the interest rates continue to go up for the next 5, 6, 7 years, or it may come down over a longer term trend, which means it is in your interest to know in which direction the wind is flowing. Okay, so to put it all together, government securities are super safe. You can invest in them for short tenures like 3 months and also have them for the next 20, 30, 40 years, which sort of makes them a better alternative to an endowment or a money back policy. Individual investors like you and me can now use a retail direct GILT account to buy and sell these securities. And finally, one needs to keep in mind 3 decision points: the post-tax returns, the liquidity, and the external scenario. Net, we think the retail direct scheme is a worthy initiative by the Reserve Bank of India, which will serve as a platform for more innovations on this front. And with this, we come to the end of this video. If you learned something new today, then do tap on to that like button and share this content with your friends. Do subscribe to the ET Money YouTube channel, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.